Every year, a few overlooked stocks quietly put the pieces together long before the market catches on.
And 2025 had plenty of them. Companies that are improving earnings, fixing their balance sheets, or sitting on catalysts that most investors simply weren't paying attention to.
We all know how fast sentiment can flip when the market suddenly discovers a name that's been hiding in plain sight.
So we're asking the fundies, which stock is being overlooked right now and could finally see some attention in 2026?
These picks are meant to spark ideas, not serve as recommendations. Always do your own research and be aware that any thesis can evolve through the year.
What is the most overlooked stock in the market right now that you think could pop next year?
One is just overlooked, it's under a lot of pressure, is Pinnacle right now. It's in private equity, it's in financial markets, it's had some growth issues that the market's concerned about. I do think that will continue to do well. I think the market's got very concerned about that sector of private capital markets domestically and also globally, because we also own Ares in the global fund as well. But I do think private markets and capital markets are still quite robust, and there's not a lot of warning signals that we have at the moment. So I think those sort of stocks like Pinnacle, should do quite well in 2026.
I'm going to pick Adidas here. So Adidas, as you know, the world's second largest athletic sportswear company, particularly focused on performance running and leisure wear as well. They had a really strong product cycle. So they're actually growing revenues at about 10% year on year. And we expect that to continue with the World Cup, where they're kind of the main sponsor of as well, going into 2026. They ran into a little bit of trouble with tariffs in 2025, but US is actually a pretty small part of their business, and that was overplayed in the share price. So it's both a good opportunity from a quality perspective, but also a valuation perspective.
Well, I think one stock the market is overlooking is that old cycle stalwart, deep cyclical Sims Metal, which is naturally benefiting from firming ferrous scrap prices and non-ferrous scrap prices. Sims has been a business that successfully produces, buys, sells and processes scrap metal, which is important as the world grows out its electric arc furnace footprints. But there's an interesting development, and that's a small part of the business that's capturing some attention, and that's a little business called Sims Lifecycle Solutions, which processes IT assets. It basically recycles old waste, old data centre waste, old computers. And the business is flying. It's doing particularly well at the moment. And it's interesting that DRAM chips have had a 5-fold increase in price. And Sims Metal, of course, recycles DRAM chips. And that has resulted in bolstering of that group's trading contribution. So we expect that the SLS business, the Sims Lifecycle business, to contribute earnings about 3-fold the size of what they've done before. So Sims is moving through a trough year in earnings. It had a difficult year in 24. And we think Sims is a stock that's about to move higher and perform well.
Well, as a broad sector, healthcare has been on the nose in the last year. The company that we like is actually doing a lot of things right at the moment, and that is Sonic Healthcare. They've obviously experienced a bit of a decline in the post-COVID era. They were doing a lot of the COVID testing that led to a couple of years of fantastic profits for the company. They used it to pay down debt and then make a few very sensible acquisitions. But they had a bloated cost base coming out of COVID, and it's taken some time to right-size that. From this point, we expect some pretty strong earnings growth over the next couple of years. We think you'll get good operating leverage as revenues continue to grow, and we should start to see some margin improvement for the businesses that they've bought, particularly in Europe, and they'll really start delivering on the earnings front. So it's trading on about the most attractive multiple that it has traded on for some time now. And they're pointing to double-digit earnings growth this year, and we expect similar sorts of earnings growth for the next couple of years.
Probably sounds a little bit perverse, but it's a gold company, Santana Minerals, New Zealand. So traditionally a really hard area to permit new mining projects. This ore body looks fantastic, and the government there has certainly got a new process in place for moving these projects forward. And we think 2026 is going to be a really exciting year. If they get those approvals, then the stock is worth a lot more than it's trading at today.
Coast Entertainment Holdings is the old Ardent Leisure business, and there was a tragedy probably about 10 years ago up there, and it was pretty catastrophic. There's a whole new board, whole new management team. They're doing a fantastic job in re-engineering the business. They've spent money on the theme park in terms of bringing up the safety levels, also rolling out new attractions at the theme park. But the big focus for us is the surplus property in the business. And they're going through a rezoning process now that's been expedited by the Queensland government. And that's going to free up, we think, around 15 hectares of surplus land. The group owns about 55 hectares up there, but the theme park sits on about 30 hectares, but there's 15 free. We think that surplus land is probably worth $50 to $60 million. And potentially more as they develop it with a partner. So there's a big story on surplus land there, but also the theme park is tracking a lot better. Attendance levels are getting back to 2016 levels, and the revenue is nearly up to 2016 levels as well. So there's an earnings growth story as that recovery in the business takes place.
Cuscal is the largest position in our Australian fund, so I have to say that. I don't think it's quite as missed as it was even 6 months ago. There are more people picking up on the story. But this is a really good quality business that I still think is under-owned and undercovered in the brokerage world. It's actually a decent sized market cap, so with a bit of growth, it can be one of those stocks that migrates into the indexes. And we see lots of earnings growth here over the next 5 years in a really safe, secure way. They've bought their biggest competitor. There's a lot of synergies to come out of that. We think the earnings are going to march up pretty much every year for the next 5 years, and that's going to look attractive in a market where I think that's quite hard to find.
One stock that's being overlooked, I would say, is Macquarie Group. And for good reason. For the last 3 years, it has continued to disappoint from an earnings perspective, downgrade after downgrade. And there are a few reasons for that. So firstly, they're very tied to capital velocity. As cash rates rose, capital markets slowed down and activity slowed. That is naturally quite negative for Macquarie Group. They were also cycling really strong earnings in their commodities business from the polar blast of a few years ago, and they were unable to get a few transactions away, key transactions with their renewables business in Europe. We believe this is changing. We're positive on the outlook for capital velocity. We believe they've undercooked the earnings, the management fees and the performance fees in their MAM business, and we believe that there will be some transactions that get done over the coming months. In addition to that, they've just divested their public markets business that was very low returning, and the banking business is just going from strength to strength. So we look at Macquarie versus the big four banks and the relative valuations, and we just see Macquarie as being an absolute standout when you consider the earnings growth ahead and then really being at the bottom of the cycle right now.
Yes, we really like a weird, nichey little Japanese stock called Cover Corporation. So Cover Corporation is a talent agency for VTubers. So when you can stream with your camera on, your camera off, or you can use an avatar. And those who use avatars are called VTubers. It's actually one of the fastest growing parts of streaming at the moment. And Cover Corporation has demonstrated exceptional monetization abilities. So when you're a streamer, you go from basically making most of your money from subscriptions and donations when you join Cover Corp to broadening that out to things like merchandising and live events and concerts and sponsorships. I think their revenue per VTuber is something like $3 million annually. And so this year, I should mention, the stock is off something like 40%. So we think that's created a buying opportunity. It's going through a bit of a reinvestment year, which is why the market has overlooked it. But it's growing 20 to 30%. Management has historically been quite conservative in terms of guidance. And I think that you'll see it emerge from being this weird, nichey sort of VTuber player to more of a global IP franchise.